Good morning, good afternoon, and good evening to all of you, and thank you for joining today's webinar. Today's webinar will be on the trends and forecasts for Africa's grid-connected PV markets. Today's speaker will be Benjamin Attia, research analyst at Wood Mackenzie. Before we go to the webinar, I'll give you a short introduction about who Solarplaza is, who am I, and what will we learn today. Then we'll go to the actual presentation, and afterwards we'll have a Q&A with Ben to answer all your questions. Today's webinar is in the run-up to our Unlocking Solar Capital Africa event, which will take place 16 and 17 October in Dakar in Senegal. It's a conference bringing together over 350 decision makers in the African solar industry. It's mainly about project finance, and besides the super interesting track on-grid, we'll have an off-grid track organized by the Global Off-Grid Lightning Association, GOGLA. And besides all the program and content, we'll also have, of course, extensive networking as in our events. That brings us to Solarplaza. We do conferences all around the world about solar energy. I think we've been now in over 35 countries in 140 events. And besides Unlocking Solar Capital Africa, the Solar Future Nigeria might be interesting as well for you. This is a more specific event focused on the Nigerian solar market. Also here we'll have utility scale solar, mini grid, CNI, and off-grid solar, and making solar bankable, which is a wider focus than Unlocking Solar Capital Africa, which is focused on all emerging markets. And then to today's webinar. Before we start with the presentations, some practical notes. If you have any technical issues, please use the chat box. We have a team here to help you with all your issues. If you have questions about the webinar, about the presentation, please use the question box. We'll have a question or a Q&A after the webinar, but you can already during the webinar ask all your questions, and we'll send out email with the recordings and the presentation slides later this week. So those will be available. That's the most asked questions, so that's not needed anymore. And then to today's presenter, Benjamin Attia. As I mentioned, he's a research analyst at Wood Mackenzie, and he will give us an overview of the trends and forecasts for Africa's grid-connected solar industry. And Ben, we're unmuting you and handing over controls, and then you should be okay to start.
Great, thanks everyone. Well, good morning, good afternoon, and good evening, and welcome to the webinar. It's great to just have the opportunity to present on some of the work that we've been doing here at Wood Mackenzie on looking at grid-connected PV markets across the continent of Africa. We're quite excited to be partnering with Solarplaza on the event, and look forward to meeting many of you in Dakar in October. So just a brief overview of Wood Mackenzie before we start. Wood Mackenzie is a global energy and extractives industry advisory, research, and consulting shop. We have offices across the world, and we have dedicated research and consulting practices. And we've created recently a new breakout called Power and Renewables, which has been supported by the acquisitions of Green Tech Media and GTM Research, which is where I come from, as well as a group called Mate Consulting, which are a wind research and consulting shop that are now part of our team as well. So putting all of those together, plus the power research from Wood Mackenzie, we do have quite a broad range of expertise across the power and renewables market and across the entire energy transition. So when we take a look at African power markets and African renewable markets and how solar could fit into that, the sort of most obvious question is thinking about where the opportunity is or the investment case is. So if you see high growth expectations for electricity demand, we see existing weak infrastructure, does that mean that it's a barrier, or does that mean that it's an opportunity? And that's a great question. And again, of course, across this entire presentation, I'll have to be very careful not to generalize across the entire continent, as obviously we have very clear differences in North Africa versus the rest of Sub-Saharan Africa, and even within Sub-Saharan Africa, some very specific country, regional, and even local nuances. But at a high level, just to keep the conversation going, if we think about the performance of state utilities across the continent, In general, it's quite poor. We see an average score for reliability of supply from the World Economic Forum Global Competitiveness Index of less than 3 out of 7. Some very poor performance in terms of average interruption and duration frequency indices from the World Bank. And we see distribution loss rates that can range as high as 40%. Of course, everybody knows that there's a massive problem in terms of access to energy across the continent, with about 600 million Africans without access to power. So what this means for the solar market when we're talking about grid-connected PV is that we're talking about its additive growth to the power mix rather than substitutionary, as we see in most of the advanced economies, where solar is outcompeting coal and gas and nuclear on price and forcing early retirement of some of those conventional generation sources. For the most part, across the African continent, what we're seeing is that because of the rapid growth in electricity demand, because of the problems with access to energy, because of the poor performance of many of the continent's state utilities, what we actually see is that adding solar to the grid is increasing the total peak demand, peak available capacity, rather than displacing existing generation. And that's an important distinction that we see in this region, to a more extreme effect than elsewhere across the world. If you look at the rapid growth of electricity demand across the continent, some estimates assume that we might see between 200 and 400 gigawatts of new grid-connected generation capacity by 2030. Of course, that's a wide range, but that does depend, of course, on how much of it is renewable and what our capacity factors look like. But either way, even at the low end, that's a massive increase in grid-connected generation capacity. So that bodes well for increases in solar demand on the grid. However, most African utilities and the regulatory environments that they operate in can make it quite difficult for independent power producers. So most of the markets either have fully public ownership, mostly public ownership, or some degree of mixed public and private ownership across generation, transmission, and distribution. And there are actually a pretty small list of markets that have fully private or mostly private operations that allow for IPPs to participate. So with the exception of South Africa, which of course is a bit of a special case, across the Sub-Saharan region, most power markets have yet to unbundle. So about 70% of countries across the region currently rely on vertically integrated utility structures. That proportion is declining, but movement has been relatively slow. There's a really interesting World Bank study that came out a few years ago on the fiscal health of Sub-Saharan African utilities. And I, along with some partners, have written a number of articles about the fiscal health of Sub-Saharan African utilities and some of the things they can do to bring about utilities of the future without changing too many things that would be, capital intensive. But that World Bank report highlights what they call quasi-fiscal deficits, which is essentially just the net profit or net revenue on a unit of electricity. And the average quasi-fiscal deficit for 1 kilowatt hour produced across all of Sub-Saharan Africa is actually minus 12 cents US per kilowatt hour, which means that on average, a Sub-Saharan African utility loses 12 cents per kilowatt hour. They can range as high as 49 cents a kilowatt hour. At the time of the study, there were only 2 profitable Sub-Saharan African utilities. The National Utility of the Seychelles and Umeme in Uganda were the only 2 utilities across the continent a few years ago that were not loss-making. There are a few that on an annual basis are approaching much more stable revenue growth. Tanesco is a good example, but on the whole, the utility picture is quite bleak. And in most markets, we don't see those utilities leading the charge for creating demand for solar. We do see them, many of the state utilities such as BPC in Botswana have started to issue recent tenders for grid-connected utility scale projects. But in the most part, Africa's electricity transmission will depend on private IPPs, more so than utility-led procurement like we've seen in other markets, mainly because they're not necessarily structured to be able to do that if they're still vertically integrated, still public ownership over generation, transmission, and distribution. If we see their creditworthiness or their sort of off-taker risk is relatively sketchy, they may be over-leveraged in some cases. So this can be a little bit difficult. This is a particular issue for renewables, of course, since they're not dispatchable. So if we take a look at the solar market and try to see how it fits into this picture, we get a sense that the global PV market, after 2018, where we saw a very, very slight decline in growth, the global market will rebound this year and next year. And then after 2020, we're going to see on a global basis, installations are going to plateau at around 125 gigawatts per year. There's a lot of reasons for that. I won't get into those because they're not all Africa specific. But what we do see is that African PV is actually going to take off quite rapidly in 2019, and then again in 2022. It's a relatively small proportion of annual installations. It won't cross the sort of 6% of global installs mark even in 2024. But the reason I'm showing you the global picture is twofold. The first is we need to understand where the global supply-demand balance sits, because that has a massive impact on component pricing. And that trickles down even to emerging markets across Sub-Saharan Africa and of course, even in North Africa as well, where we've seen some low prices, which we'll talk about more in a moment. But beyond that, what we also see is that as some of the traditionally large-scale markets, the Chinese market, the Japanese market, the US market, the Indian market, as we start to see some of those countries either reaching PV saturation points or having some policy changes that are resulting in their markets to actually decline rather than grow on an annual basis. The reason that we see installations start to plateau in the next few years is because emerging markets are going to increasingly fill that gap. And as we see, while Africa does take a relatively small portion of that total, on a growth basis, a cumulative average growth rate basis, Africa will make up a decent portion of that lost ground from those advanced economies. So across the solar and wind space, we'll see about 60 gigawatts of solar and wind capacity installed across all of the African continent by 2024. We do see that utility scale procurement for both solar and wind is quite slow. Again, that goes back to the dynamics typically with state utilities and with the regulated power markets. And on the DG side, we do have in most markets a lack of a robust value proposition. And that's mainly due to subsidized retail electricity prices, the regulation of power markets, the lack of effective net metering policy or net metering policy at all in some cases. And of course, unreliability of grid means that net metering is not really a clear case regardless. So most of this growth is going to come from the utility scale space, although there is some friction. So when we zoom back into African solar, we expect that in this year, in 2019, Africa across the entire continent will deliver about 3.5 gigawatts of new grid-connected PV capacity. That's a demand growth of about 220%. This will be a bit of a boom. We'll see increasing growth in 2020 and 2021, another large peak in 2022, and then things will begin to stabilize a little bit in 2023 and 2024, according to Woodmac's latest estimate. Egypt and South Africa will be the region's only 2 gigawatt scale annual markets over the next 5 years, and they'll account for about 30% of the continent's total installed capacity through 2024. We will see some demand driven by emerging markets that will hit installation capacity limitations for intermittent renewables because they have weak and mismanaged grids. So for example, if we see some countries that may tender for 100 megawatts of PV and they have a 400 megawatt peak capacity grid that has some high transmission losses and a bit of a difficulty with managing power flows across the system. After that 100 megawatt project, if it is connected, after that 100 megawatt project is finished, we may have 500 megawatts of capacity, but looking at the capacity factor of solar, we're looking at less for peak demand. And that actually also gives us some issues with the ability to add more intermittent solar to a grid like that. So some of these countries may run into some more issues in the short term than others have anticipated. We also have seen some risk-protected programs, Scaling Solar, Get Fit, IFC and the EBRD have been quite active in countries like Egypt. And this has actually pushed down across some of the tendered projects in Africa. It has pushed down utility scale solar bids in a few cases to quite competitive prices, which does put some pressure on future wind development across the continent. If we look at the utility scale pipeline, total, if we include operational capacity, which is just under 4 gigawatts across the whole continent through the end of 2009, for the first half of 2019, we have about 26 gigawatts of total pipeline, about 4 gigawatts of connected capacity, about 7 gigawatts of contracted and under construction capacity, and then over 15 gigawatts of pre-contracted capacity. And of course, because of the outsized risks of operating in emerging markets with some off-takers that may not be the most bankable, there is a high attrition rate on that pre-contracted pipeline and even on that contracted pipeline. So those are numbers that we need to take into account when we're looking at our future outlook. If we look at the ownership landscape, this also does include the Middle East, but for the most part, most of this capacity is actually held across the African continent, including North Africa. What we see is that the ownership landscape for who actually owns solar assets in the region is actually quite fragmented. So the top 10 asset owners represent diversity in their country of origin and the type of investor that they are, and where they actually own these projects. And the top 10 owners actually only hold about 2.3 gigawatts of about a total of 8.4 gigawatts of operational capacity across Africa and the Middle East. So that's about 4 gigawatts in Africa and about 4.5 in the Middle East. That was through the end of 2018. So we see about half of those asset owners are operating as sort of unaffiliated IPPs, but their core business does vary from renewable energy project developers. We have some upstream oil and gas players like Sonalgas, to some institutional investors like Old Mutual as well. So we will expect that this landscape is going to change pretty rapidly over the next few years because of that 7 gigawatts of pipeline capacity that we have coming down the line, that will drastically change this picture in 2019 and in 2020 as well. So if we just return back to those prices for a minute, if we look at from 2017 to 2018, we've seen bid prices on a global basis fall 37% year over year, such that the average bid price for a newly procured utility scale solar project anywhere in the world was $40 per megawatt hour. In the Middle East and in Africa, if we bundle them together for a moment, the actual average bid in 2018 was $27 a megawatt hour. And that is largely driven by the procurements that have happened in Egypt at Komombo, as well as the recent procurement in Tunisia in 2019, which will drive that average even further. We've seen some very low procurements across the Middle East nearby as well, which have pulled that average down a bit. But Africa is not too far behind. We've seen recent tariffs in Zambia and Senegal that are about 4 cents or $40 US per megawatt hour. Egypt and Tunisia are now under $30 US per megawatt hour. And what we see is that those private IPPs that are looking at the power space across the African continent are looking for de-risked environments. So things that have happened in Kenya, for instance, where tariffs of projects have been cut after the project has been COD'd, the tariff was cut in half. This can pose some serious risks for investors getting comfortable with the regulatory environment. So scaling solar, Get Fit, have allowed some sort of risk-insulated environments or bubbles perhaps to allow private capital to enter those markets and to drive some of those recent bid prices across the African continent down even further. But what this does is it creates some relatively intense competition. So winning bidders are typically seeing equity returns, sub 7% in some cases, and that margin compression affects everyone across the solar value chain, not just the investors, not just the developers, not just the EPCs. So if we look at where the global auction prices are going, these are the lowest 15 solar auction bids on a global basis. So just a few weeks ago, we saw the new record low bid in Portugal, which beat the new record low bid from even a few weeks before that in Brazil. But we did have a drought across all of 2018 and pretty much the first half of 2019 where we didn't see a new record low. But if we look at just the lowest 15 procured bids at this time, we do see that Egypt and Tunisia do make that list with bids under 27 US dollars per megawatt hour for Egypt and under 25 in Tunisia from Skytech Solar just a few months ago. Also, if we look at sort of this top 15 picture, we do see that India is quite well represented, and that 15th bid is about 35 US dollars per megawatt hour on a levelized basis. And if we're looking at some of those recent prices that we've seen in Zambia and Senegal and elsewhere, not too much farther behind the leading edge on a global basis. So what we started to see is because some of these utility scale projects do have long lead times, they do have some outsized risks in certain markets. We're starting to see some investors start to look beyond pure grid-connected solar. So we've seen a lot of interest in PV plus storage because of the sort of compelling value proposition on weak grids, although deployments have been very, very slow, and in most cases haven't moved forward, and that's because there's very high costs for storage, and the regulatory environment is not directly in place to value its full benefits to the grid. But in South Africa, there's a large 1,400 megawatt storage plan that Eskom has been speaking about, and if it were to come online, and if we were to have some relatively conservative cost estimates for PV plus storage projects and relatively fixed assumptions for gas prices for CCGTs at about $6.5 USD per MMBTU, we could actually see that solar plus storage projects could displace gas peakers from Eskom by as soon as 2023, and that's quite a compelling picture in a market like South Africa, where there's a lot of troubles with how Eskom's current fiscal situation, let's say. So if we do, again, we don't want to generalize the entire continent because there are almost 60 countries and a lot of nuance here, but if we just sort of group the North African markets together because they do behave quite similarly in terms of power and renewables, and if we group the Sub-Saharan markets together because they do behave quite similarly, again, due to power and renewables, we do see that there are really, really different, starkly different use cases for grid-scale solar across the two regions. So if we think about how utility power suppliers and network operators, the C&I off-taker space, and then also the IPPs, what their needs are for storage, those are quite different. So at a very high level, without going into this too much, we have questions about reliability, we have questions about load deferring and load shifting. There's a huge amount of question on displacing diesel gensets as backup generation, so reduce reliance on using off-grid or behind-the-meter diesel. And then also in the North African market, where there's a lot of questions around grid balancing, valuing the full value stack that storage can offer, as well as, again, reducing reliance on fuel and improving power quality as well. So when we're thinking about the storage market across the entire continent, we do need to think about markets in their context. So at a high level, we do see that compared to other investments in the energy space, renewable or not, we do have a relatively low risk, low return picture for both solar and wind projects. There is a bit of a premium in emerging markets for both solar and onshore wind, but ultimately solar and wind are in for investments. So they're fixed price contracts for the most part, dependent on the sun to shine and the wind to blow, as opposed to trying to forecast variable pricing, feedstock, commodity market contracts for gas or for coal or other things like that. So in terms of looking at the investment picture for grid-connected renewables, particularly at the utility scale in this graph, what we're thinking about or what we're looking at is infra assets ultimately. And those IRRs are continuing to get depressed by these competitive auctions. And we do see that that commercially addressable market in emerging markets is relatively small, but there is that risk premium of sort of 23 to 25% on top of the mature market picture. However, infra assets, although they do typically make relatively low risk, low return infra returns, they also do face some infra constraints. And those could include things like dispatch risk, returns risk, Forex and currency exchange, dispute resolution, termination payments, collateral assignment, off-taker payment support, transmission interconnection risk, regulatory risk, and of course, force majeure, which is true for all assets. But these can sort of affect the bankability of contracts with state utilities that may not be the most bankable, that may not be the most creditworthy off-takers. And that slows the process down, that causes high attrition in that pre-contract pipeline, and it creates some issues. And there's one thing that the African markets are slowly starting to move to that will actually help with bankability a decent bit, and that's regional power trading. So Africa currently has 5 power pools, So there's the East African power pool, the Central African power pool, the Southern African power pool, the Western African power pool, and then Comelec, which mainly operates in North Africa. And what those things allow is, we see improved utility performance. Sometimes we can see bulk power sales that can drive down power prices at the procurement level, the transmission level, or even in some cases at the distribution level. And it does improve the bankability for new IPP projects, particularly variable renewables, because if we have trouble matching generation and load in a certain market, if we expand the scope of where that generation and load is being sited, we can start to see how we can balance the grid a little bit more easily by matching supply from a solar project in one country to daytime demand in another country that may not be able to be met by conventional generation. There's also some benefits with coordinated infrastructure planning that promote regional political cooperation, economic dependencies, and things like that. But if we do think about where sort of the investor activity and the focus and the developer activity and focus have been shifted, there is a bit of an impatience or maybe a shift of focus away from doing business with some of the constrained Sub-Saharan African public utilities that might be difficult off-takers to work with or may have some other issues to deal with despite their interest and their understanding of the renewable space. So what we're seeing as things have moved a little bit slowly is that a lot of investors and developers, if they're either hunting for returns in the clean tech space across the continent, or simply just looking to win projects and build a pipeline like a developer might, they're increasingly looking to the end user. So if we think about that in those three buckets of industrial end users, commercial end users, and residential end users, we can see that there are some pretty clear value propositions for investors and developers to offer these end users. So that can come at the industrial level. Typically across the continent, we're seeing a lot of activity in the extractive industries, so the mining, onshore oil and gas, maybe some other heavy industry that could fit there. In the commercial space, we're seeing a lot of C&I activity, again, for, in some cases, power, energy bill savings, but mainly for reliability of power in most markets. Nigeria is a great example there. And then diesel displacement behind the meter is another piece of that picture. So main sectors there could be consumer retail, malls and the like, hospitality, the MUSH sector, some municipal universities, schools, hospitals, things like that, and then some SMEs. And then on the residential segment, what we're mainly talking about is the off-grid residential customers that lack access to energy. There's 600 million people across the continent, and that could be addressed through solar home systems, through mini grids, etc. So while this presentation is mainly focused on grid-connected markets, because there are a lot of implications for the power sector, for future demand for any type of grid-connected generation, be it solar, wind, or any type of conventional generation, and as well for the utility business model, I do want to dive into some of the innovations that are happening on this side of the market, just for a few minutes here. And just as a quick aside, we do have a public report on the investment landscape of the off-grid market that's available for public download. There's a link at the end of the slide, so when you get that, feel free to download that. And we do have forthcoming research for our clients on the C&I space across Africa, as well as the renewables for extractives market later this year. So if you're a client of WoodMax or interested in that, feel free to reach out. But if we do look at the off-grid space, obviously this is a massive opportunity in the energy transition. There's some macro trends that drive it, demographic shifts like urbanization and population growth across the African continent. We already talked about rapid growth in electricity demand, and then the massive investment gap in electricity supply, both on-grid, C&I, mini-grid, and off-grid. So I won't dive into some of these numbers, but there's a pretty clear value proposition here at the base of the pyramid. So a lot of what we've been tracking in this space has had to do with the investment landscape. So we've seen that at the end of 2018, there was about $1.7 billion invested into energy access. This is increasingly seeing participation not only from strategic investors, which I'll talk about more in just a minute, but also from traditional IPPs that were building both conventional and renewable projects on the grid, have now started to look at these C&I segments as well as the residential segment through off-grid markets. And we've actually just crossed the $2 billion market, $2 billion mark according to our data, which again was created in partnership with Energy for Impact for this report. We still do see some dominant trends. Most people focus on pay-as-you-go solar home systems using private capital and dollar-denominated money, but we do see some of those things starting to change a bit there too. The geographic concentration, most of this activity is happening in Africa. East Africa is, of course, the hotspot, but we're seeing increasing focus and shift towards West Africa, small pockets of interest in LATAM and APAC. And then those strategic investors that I mentioned. So many of these players have the ability or previous track record of investing into power markets, into renewables markets, into IPP generation across the continent. And we're increasingly seeing them move towards these C&I segments, these off-grid segments, through strategic investments, through partnerships, and then indirect investments into funds and financial intermediaries that also operate in this space. And increasingly, we're also seeing them moving towards fully commercial lines of business rather than sort of CSR or sort of testing the waters in one of these in-between phases. So much of this activity, much of this investment is coming through fully commercial lines of business, which is a deep sort of reinvention of the utility business model with customers at the last mile, be they residential or commercial or industrial. And we're seeing that mainly across the African continent because we want to change what the utility business model looks like, and we can do that in a way where we don't have a lot of competition from incumbent utilities, as many of these players do in their home markets where they operate their core business. And what that means, part of this redefinition of the utility business model includes what we would call value stacking. So that means that across using the sort of pay-as-you-go value chain of product, retail, finance, and service, on top of that, there are a number of other things that we can offer. Many of these customers lack more than just access to electricity. They have evolving needs. They have willingness and ability to pay. So that can include things like internet and telecom service. It can include other appliances or fast-moving consumer goods or LPG cook stoves. It could include some financial products like transaction clearing, loans, insurance. And then it could also include some other after-sales service like monetizing customer data, using some co-marketing and co-branding, or offering sort of quasi credit score services as well. So just to zoom back out on that utility business model a little bit, this picture includes a bit more of a zoomed out view of how the utility business model is changing, how power markets are changing. But the key takeaway here is that traditionally we had a one-directional utility business model where the utility generated electricity and then sold it through transmission and distribution to the end customer, whether they owned those pieces or not. And now what we're seeing across the world is a bi-directional relationship between the utility and the customer. So that means things like DSM, demand-side management, using behind-the-meter distributed generation, advanced meters, energy storage, either front of the meter or behind the meter, through electric vehicles or standalone batteries. All these abilities of customers that they have a value proposition to now offer the utility as well. And that's quite compelling. So what we see across the African continent is that many of these things are happening slowly at the grid level, led by state utilities, but particularly off-grid, particularly with C&I customers that are signing direct corporate PPAs, and particularly with some of the more innovative utilities across the continent. There is, these changes are also happening. They do look a little bit different, and it is a bit more complicated, but the value proposition for these utilities and their customers to skip ahead to the leading edge, or the term we like to use is leapfrog, right? For this to happen in the utility space across the African continent is not an unbelievable picture. So I think there's a lot here. I'll stop there, move over to Q&A, but I'm happy to discuss any of these questions. And then just as a last bit, if you are interested in that research, you're more than welcome to download it at this link when the slides are sent around. But thanks very much.
Thanks a lot, Ben, for this very interesting presentation. And indeed, we'll go to the Q&A. First, a very simple question about a difference you mentioned on slide 8. I'm not sure if we can scroll back to slide 8, but there was a question: what's the difference between affiliated and unaffiliated on the slide? So that would clarify it for the attendees.
Sure. Yeah. So that's back to the asset ownership landscape data. Simple answer there is affiliated. An IPP that's affiliated with a utility would just mean the project development arm of, say Enel or Engie or EDF Renewables, or one of these pieces that is tied to a state utility versus an independent IPP, an independent power producer, if you will.
All right, great. That's clear, I think. And then a question coming in: the 600 million Africans without access to electricity has not changed in years, from what I can see. It will be useful to know which markets are successfully getting C&I clients to adopt solar as part of their energy mix. In Kenya, for example, the high capex is still putting them off. Are there leasing options, or? So I think the question would be, what are the options to overcome this challenge of the high capex here for C&I, and in what markets is it really taking off?
Yeah, sure. That's a good question. So the largest C&I markets across the continent right now are South Africa, Nigeria, and Kenya. Ghana is a close fourth there. Still quite nascent, but we do see significant demand, significant uptake, and many of the developers that we've spoken to quite recently have told us that their pipelines for contracted projects are actually quite large, a bit larger than I personally expected. So I do expect that this boom is going to continue. I'll save on any specific data points at this stage since we're still in the midst of that research, but we will have some more soon. But I think just at a high level here, what we see is that there are relatively different drivers for those markets. So in Nigeria, we do see relatively low bill savings for most clients, but we are seeing more price certainty because we're not worried about fluctuations in diesel prices and FX risk and some of those questions. And then, of course, we have the diesel displacement driver there as well, even if the cost savings are not massive. Whereas in Kenya, where we see a bit more of a reliable grid, relatively speaking, we do have more of a value proposition focused on bill savings, on sort of price certainty into the future. And then in South Africa, because of load shedding and because of some of the troubles with Eskom, many corporates are looking for are looking to C&I installers for similar value proposition there as well. So those are some of the largest markets. And then at a basic level, we can dive into this more if there are more questions. But yes, CapEx is declining. We do have a pretty decent picture of what C&I CapEx looks like across the continent, and it has declined over the last 2 years relatively rapidly at about a rate of 8 to 12%, depending on the market. And what we can do to get around that is mainly offer leasing models. Obviously, capital is tight. Using local currency is pretty tricky. Interest rates, particularly in West Africa, can be above 20%, so that can be a little bit difficult. But what we do expect, for the most part, is that customers will increasingly prefer leasing models. But because paybacks in some of these markets are so quick, even on a 10-year PPA or a 15-year PPA, payback periods can be as short as 3 to 5 years.
All right, thanks. That's clear. One question before we move on with some more content-focused questions, just to clarify, what exactly do you mean by grid-tied solar? So to clarify that definition, do you mean SHS, commercial and industrial, or microgrid systems? So where do you draw the line, basically?
Yeah, so I would say grid-connected solar includes industrial scale solar that is connected to the grid, commercial scale solar that is connected to the grid, and utility scale solar that's selling to a utility or a TSO. We would consider microgrids or mini grids to be off-grid. We would also, of course, consider solar home systems to be off-grid as well. The reason that I did dive into that sort of as an aside is because it does have some serious implications for the future of the utility and the future of the power market. So we see those, while they are separate segments of the market, we see them as very, very interoperable and very related and correlated. So our study of the African power sector includes, a holistic picture of what's happening both on the grid and off the grid, so that we can make sure that we have an idea of how one informs the other, if that makes sense. All
right, yeah, thanks. That's clear. And then some more questions come in about mainly drivers and barriers in the market. One is, what is the hardest challenge in investing in C&I residential sized projects to really enhance the electrification push for corporates, and then beyond CSR?
And sorry, what was that last part?
Beyond CSR, that's added to the question, but I think it's mainly about what is the hardest challenge for corporates to invest in C&I and residential projects. Gotcha.
Yeah, I mean, part of it is honestly customer sensitization in most of these markets. So many of the developers who I know and I speak to regularly have told me that, it can take, many months to even, a year and a half to, speak with the customer, educate them about the technology, the costs, the contract structure, the financing arrangements, just to get them comfortable. It's also quite difficult, particularly in C&I solar across the world, not just in this part of the world, but globally, C&I solar faces a barrier of essentially getting, CFO, for instance, to lock in any sort of long-term contract can be quite difficult. So typically PPA tenors for corporate procurement are a good bit lower than the ways that utilities would sign a 25-year PPA as a standard, because they have integrated resource planning forecasts into the long term, whereas some corporates may be hesitant to commit themselves to a 25-year PPA. So typically those PPAs are 10 years or 15 years, and in some cases there's the ability for them to extend it partway through. Using some of those developers use that model, but yeah, it's a lot on the customer side in terms of barriers. There are some supply chain issues. There are some 24-hour reliability issues without using storage. So we're seeing a lot of those developers hybridize with diesel and just displace daytime diesel demand. But yeah, I think I would say sort of on the soft side, one of the largest barriers is just working with customers, helping them understand long-term energy planning and things that they wouldn't have otherwise been willing to commit to.
All right, thanks. That's a clear answer. And then another question about C&I. What's the common size you see at this moment? So the average size of these projects, and do you see a trend in this size growing on average or declining? So what's the trend there?
Yeah, good question. Bit early days in our research to answer that definitively, and of course that is also a very market-specific question. Off the cuff, I would say our average system size in the projects that we've tracked is about maybe 700 kilowatts on average across the entire continent. Of course, in markets like South Africa, we see much larger systems. In Nairobi and outside of Nairobi in Kenya, we see maybe more of the medium scale systems in the 400 to 700 kilowatt range, and then we see much more on the smaller scale, more targeted at the SME segment in places like Nigeria and Ghana to date. But again, early days across the entire market, so certainly do expect that to change. And so as storage gets cheaper and we have the ability to add modularly to existing solar capacity, and then improve the usage hours of a C&I solar plus storage system and displace diesel even further, I would expect those system sizes to rise over time, yes.
All right, thanks. And then another question on solar home systems. What will it take for solar home systems in Kenya to show the same promise of growth like we see in C&I systems? So what particular barriers see you to overcome for SHS?
Yeah, I mean, I think that the solar home system, the trajectory of growth in the solar home system space has already outpaced the trajectory of growth in C&I. That market's actually a few years ahead of the C&I market in terms of national level growth estimates. But I would say some of the biggest barriers in the SHS space in Kenya and across East Africa, because it is such a hot spot. I showed that heat map before of where we see a lot of that capital flowing, where we see a lot of activity. East Africa, because it was sort of the first region to adopt mobile money, which enables the pay-as-you-go business model. As a result of that, we've seen many of the largest, most scaled solar home system players operating in close proximity to one another in East Africa. So we are starting to see, I wouldn't say the market is saturated per se, but we are starting to see them bumping into each other more and more And there has been some lessons learned by some of those companies that now some of their peers and competitors are now taking to West Africa. It's a new promising markets like Nigeria to Togo, places where mobile money adoption is on the rise, and there's a bit less competition.
All right, thanks. That's clear. And then a lot of questions are coming in, by the way, so I doubt that we can answer them all. But a question on business models for CNI. Any insights on competing business models across the CNI market, and what financing and operational models are emerging or even winning, so to say?
Yeah, that's a good one too. Yeah, again, a bit early in our research to say definitively. I would say, again, off the cuff, that most of our work, most of the projects that we've captured have seemed to use, there's a bit of a mix between the lease model and between the, pure PPA. But I do think that we're seeing a bit more of that and a bit less on the loan and financing side, and very, very few cash sales do we see for systems. So we're really looking at cash deferral upfront and then bill savings over time. And because in most markets such as Kenya, there is a relatively large spread of opportunity to save on electricity bills on a monthly basis, most people are willing to take that slight hit for a developer margin in a PPA or a lease. And in some cases where financing is a bit more readily available, South Africa is a good case there. We do see some more loans, but I'd say it's a bit early to tell which model has won in the continent quite yet. And again, regionally and country specific, and off-taker specific as well too. Depending on cash flows, level of, we've seen a lot of breweries and beverage manufacturing. That's a pretty decent segment across the CNI space in the region. Namibia has a number of projects in that space. So many of them are owned by maybe InBev or Coca-Cola or something like that, and they may be a little bit more willing to take those things on a corporate basis rather than, at the corporate level to take on those contracts and those risks. Rather than individual off-takers. So there's some nuance there that maybe don't want to dive into quite yet, but yeah, it's a good question.
All right, thanks a lot for that. And then maybe a question that came in which can function as a follow-up question on this. Do you also see local banks already financing these projects, and in which countries do you see that?
A little bit. It's starting, yeah. More so in East Africa than in West Africa. It's obviously a very different financing picture in South Africa, so things are a lot farther along, and a lot of the commercial banks in South Africa are quite comfortable with solar and have even started to look at securitizing some portfolios of CNI projects and even residential projects in some cases. That's a bit early days, but it is happening. I'd say in West Africa, local financing is very, very difficult. There are some national funds, like in Nigeria, for instance, that the BOI has set up for solar projects that pretty much all the developers rely on. Local currency financing from local commercial banks can, as I said, go above 20% relatively easily. Same thing in Ghana, same thing in Togo and Benin. So it can be a little bit tricky to leverage local currency. But we have seen some of them, Daystar Power, for instance, raising venture capital so they can, you can still use that to finance some of their projects, and then also thinking about, leveraging some of those public funds.
All right, thanks. That's clear. And then slightly different question. How do you see the future of power or electric markets, and then with a reference to power trading as the grid matures?
Yeah, that's a great question. So if you go kind of back to the piece in the presentation where we were discussing regional power trading, that's still relatively nascent across the continent. But we do have 5 power pools. Most of them have been around for a couple of decades. They're relatively organized, relatively robust. West African power pool will have a lot more interconnections coming online in 2020. So we do see that maturing, and it will not be too long before we start to see those power pools start to operate a bit more like TSOs that we see in Western Europe or in the United States or Australia. It is a little bit tricky to think about bulk power trading using power pools versus a full regional wholesale market. That's a big leap. So I wouldn't say we're quite there yet. But as those power pools become more mature, there's more variable renewables, there's more transmission within the power pools and the interconnection of power pools. Of course, the DRC is actually part of EAPP, CAPP, and SAP, and that's mainly a result of the hydro resource there. But because of the increasing interconnection across these different power pools, there will be more opportunities for bulk trading. As I said, it will improve the bankability of some of those IPP projects. And as that slow trend of deregulation happens across these utilities, it's not inconceivable that in the medium to long term, we do see wholesale markets operating at a regional level rather than at a national level, because it is sort of a smarter look. If you think about the United States as a corollary and think about some of the ISOs here in the U.S., we can think about how different states and different state utilities, the IPPs that operate in different states, can sell into an ISO market like that, and it's conceivable that this could look relatively similar at an international and regional level.
All right, thank you. And another question about these power pools: how do you see that impact the financial business case for storage and the development of storage in these markets?
Yeah, it's another good question. In concept, it helps a lot. In reality, because the regulation isn't there to actually value the full stack of what storage can offer, it hasn't really made a measurable impact, and probably won't in the next few years. If we think about sort of the needs case and the use case for adding storage, either front of the meter, mainly in the front of the meter space, we're thinking about reliability, we're thinking about power quality, we're thinking about load shifting. So in concept, it makes a whole lot of sense to add storage to the picture. The cost element is still there. It still does. It's still cost prohibitive in most cases, but mainly, frequency regulation, ancillary services, some of the things that storage can offer at the front of the meter level aren't either allowed in regulation or aren't valued in regulation. There's no compensation for some of those value streams that front of the meter storage can provide. So until that happens, it's going to be quite difficult for front of the meter storage to really make an impact or to change the picture at the national level or within power pools.
All right, thanks. That's clear. And yeah, I think we're running out of time. I see that there are still some questions coming in. Ben, your email address is on the screen. I think people are free to email you in case of any questions.
Yep, that's fine.
That's
Happy
great.
To hear.
And my email address is on the screen for any questions regarding the event. Ben, you will be joining us in the car, if I'm not mistaken, right?
That's right.
That's right. And we'll see each other in the car. Thanks a lot for today's webinar, Ben. Very interesting, very helpful. And besides that, I want to once again point out our Unlocking Solar Capital Africa event. The websites of all the events are under the logos you'll see. And then I want to thank you, Ben, again. Thanks to all the attendees for taking time to join us today, and thanks for all the interesting questions, and hope to see you on one of our next webinars or one of our upcoming events. And thanks a lot.
Thanks, everyone. Thanks, Thomas.